Welcome to the final teaching section of the inventory and cost accounting cycle. You have learned the full cycle and how to apply it to any client. Now we bring it together with 6 real case scenarios, the red flags that warn you something is wrong, and the prioritized improvements that fix the root causes. Think of this as training your professional instincts. By the end of this section, you will be able to identify the underlying failure in each of 6 common case scenarios and explain why each one distorts the numbers. You will learn to apply the advisory response that corrects it. You will also recognize the red flags that signal these problems early and prioritize the improvements that prevent them. The goal is judgment, not memorization. Here is the first trap. A company expenses inbound freight and duties, so its standard material cost reflects only the supplier invoice price. The risk is subtle but serious. Inventory and work in process are systematically understated, and cost of goods sold is distorted. Material price variances look permanently favorable because the actual cost is the landed cost while the standard captures only the invoice. The advisory fix is to quantify the cumulative impact. Assess materiality for restatement under SAB 99, SAB 108, or a SC 250. Update the landed cost policy, retrain the teams, and correct every standard to full landed cost. Expect a one-time unfavorable variance when you do. The surprising part of Case B is how a denominator choice quietly distorts everything. The overhead rate is built on 100% theoretical capacity, but the factory actually runs at 70% utilization. So the volume variance is permanently large and unfavorable, product costs are distorted, and pricing decisions may be wrong. The advisory response is to recalculate the predetermined overhead rate, the POR, using practical or normal capacity as the denominator. Products will carry a higher overhead cost per unit because more fixed overhead is spread over fewer units, and that better reflects the true cost of capacity. Then review pricing against the corrected standards. In Case C, a physical count reveals a 15% shortage, and there is no cycle count program. That 15% is either systematic theft or counting and recording errors that have accumulated for 12 months with no early detection. Here is the key thing. Do not immediately adjust the books. Perform an independent recount of a representative sample and investigate timing differences, counting errors, system errors, or genuine shrinkage. Implement the ABC cycle count program right away, with high-value items counted monthly going forward. Post the confirmed adjustment with full documentation, and if theft is suspected, engage management and consider law enforcement. Case D is about a misclassification that inflates the balance sheet. All spoilage is treated as normal and absorbed into cost of goods manufactured, the COGM. But some of it is abnormal, caused by a machine malfunction, and capitalizing that into inventory inflates both the inventory balance and the per unit cost. The fix is to separate actual spoilage into normal, which is expected and lives in the bill of materials, the BOM, and abnormal, which is above expected and must be expensed. Calculate the normal rate from history, build it into the standard, and post everything above it as debit abnormal spoilage loss, credit work in process. If material, this may require a restatement under a SC 250. Most people assume a recurring variance is just noise. Case E shows why that is dangerous. Production uses more labor hours than the standard allows, every single month, and nobody has ever investigated why. It could be an outdated standard set years ago, chronic machine downtime, inadequate training, or scheduling inefficiency. The advisory response is to pull the prior 12 months of labor efficiency variances and calculate the cumulative cost. Then separate the variance into idle time from machine and material delays versus a true efficiency gap where workers perform below standard. If the standard is outdated, update it. If performance is genuinely below standard, investigate the root cause with production management and build an improvement plan. Case F is a cautionary tale about letting a good model go stale. Activity-based costing, the ABC system, was adopted 3 years ago, but the activity drivers were never updated after the factory automated. The drivers, like direct labor hours, no longer reflect how overhead is actually consumed. Automated products generate less direct labor but more machine time and depreciation, so the ABC model is now less accurate than even a traditional overhead rate. The fix is to reassess the activity pools and drivers. Post-automation, the primary driver may shift from labor hours to machine hours or machine cycles. Update the activity dictionary, remeasure consumption, recalculate costs, and compare before and after to quantify the pricing risk. Now step back from individual cases and learn to scan. Version 2 adds cost accounting red flags covering standard cost integrity, variance analysis, and costing accuracy. When freight and duties are expensed rather than capitalized, inventory is undervalued and margins are distorted for every period. When standard costs have not been updated in over 12 months, your variances measure the gap from an outdated benchmark. When the POR is never recalculated, overhead absorption rests on obsolete assumptions. And when all variances are disposed to cost of goods sold without investigation, cost accounting has become bookkeeping, not management control. The red flags continue across the whole cycle. Large 90-day-plus inventory with no reserve means obsolescence is unrecognized, and LC/NRV is not being applied. Counts not performed by independent teams provide no assurance and can conceal theft. A subledger and general ledger that are not reconciled monthly let differences accumulate undetected. Old unmatched GRIR balances over 60 days signal possible duplicate payments or unrecorded liabilities. Costs posted to the wrong job number ruin job profitability and billing. An equivalent units calculation not reviewed when the process changes gives wrong per unit costs, and an ABC model unchanged for 3+ years after operational change yields stale product costs. Knowing the problems is half the battle. The other half is fixing root causes in priority order. The high-priority improvements attack the most critical control failures. Implement a landed cost policy and enforce capitalization of all duties and inbound freight. Update standard costs annually before each production year, with documentation and approval. Recalculate the POR annually using practical or normal capacity. Establish monthly variance reporting with investigation thresholds for all 9 variances. Implement an ABC cycle count program. Reconcile the inventory subledger to the general ledger monthly. Perform an LC/NRV assessment at every reporting date, and enforce blind counting with independent teams. The medium priority improvements add depth and precision once the critical controls are in place. Implement a perpetual inventory system with real-time movement recording for visibility and shrinkage detection. Classify spoilage as normal versus abnormal at every production run, and expense abnormal immediately. Review joint product cost allocation annually against alternative methods. Review ABC activity pools and drivers annually after any significant operational change. Reconcile the GRIR account monthly and clear all items within 60 days. And build a gross margin analysis by product or category, reviewed monthly, to support pricing decisions. Together with the high priority list, these turn cost accounting back into a management tool. Notice the pattern across everything we covered. Each case starts with a situation, names the specific risk to the numbers, then prescribes an advisory fix, and several of them flag a possible restatement when the impact is material. The red flags are the early warning version of those same failures, things you can spot before they compound. And the prioritized improvements are the permanent cure, sequenced so you fix the most damaging control gaps first. This is how a cost accounting advisor thinks, moving from symptom to risk to remedy. Let us lock in what matters. Every case follows the same arc, the situation, the risk, and the advisory fix, and a permanently favorable variance can hide a real error rather than signal good performance. Always separate normal from abnormal spoilage, and never let a recurring variance go uninvestigated. The red flags give you early warning that standard costs, the overhead rate, or the count process have drifted. And when you act, fix the high priority control failures first, then add the medium priority refinements. Thank you for completing this section on case scenarios, red flags, and improvements.